Hey everyone, let's talk about investments and continue our discussion of portfolio theory. Now that we've got a sense of how we can use utility functions to transform investor preferences into actual decisions on asset characteristics, mostly using the statistical quantities of expected return and standard deviation of returns, now let's think about how we could apply this to actual risk assets and consider three items in sequence. First, we'll think about how we can evaluate a portfolio of risky assets. We'll then combine that with a risk-free asset. And finally, we will show that for all investors, when they have access to portfolios of risky assets as well as a risk-free asset, which is to say something like a treasury bill, their portfolio choices that are optimal with respect to their utility function will fall on a line that combines a certain risky portfolio with the risk-free asset, and all that really matters then is where each individual investor falls on that one line. But before we really are able to characterize risk assets in terms of their mean and variance of returns, we need to consider how their past performance has been. Mostly because generally all we really have to go on is the historical record, and then the way that we usually do it in either academics or in the industry is use historical performance of assets combined with maybe macroeconomic state variables, stock-specific state variables, to try to create forecasts for the future. Obviously, the most, or one of the most frequently cited phrases in finance is past performance is not indicative of future returns. But in some ways, it is all we have to go on. So past performance is something that we consider when then trying to form an expectation about future returns. But with the acknowledgement that really our expectation is at best a model, I guess. So let's look at the records since 1925, which is about when we have complete good data for the US market and world markets as time develops. And consider what would happen if you had invested $100 at the start of this record into one of a few asset classes. So we'll track the performance of small stocks in red, the S&P 500, which is of course large cap stocks, in blue, a world portfolio combining all stocks in black, corporate bonds in yellow, treasury bills in green, and inflation as measured by the consumer price index to sort of measure just how much of any return has simply been due to the appreciation of money. You can see that, first of all, this is on the vertical a log scale, so the value of our investment is not linear but actually exponential. And that's required because if you consider the evidence, the small stocks really run away with the game historically. If you had invested $100 in small stocks in 1925, by the end of 2011, this data goes through 2011, you would have 2.6 million. And that's actually about, 10 times better than what you would have realized if you had instead invested in the S&P 500, even with potentially a lot more bankruptcies in small stocks, and certainly, as you can see, a lot more volatility. If at every economic downturn we compare what the drawdown for small stocks has been, in many cases it is greater than that for the S&P 500, except maybe the dot-com period, I guess simply because most of the firms in the dot-com bubble were actually large. The world portfolio performs about half as well as that. I mean, you still get a huge return for $100 invested in 1925. You end up with 119,000 by the end of 2011, but certainly far worse than US small caps. And if you invest in corporate bonds, you get about a fifth of that, so you only get about 20,000, and you can see that the volatility of your investment in corporate bonds is generally lower also. And if you had invested in T-bills, there's really hardly any volatility to that investment. But for your $100 investment, you end up with only $2,000 by the end of 2011. Though you still come out ahead of inflation, where essentially $100 in 1925 would be worth about $1,200 just due to the price appreciation of, or I guess depreciation of a dollar in 2011. So what does this tell us? Generally, the higher the return you get on a stock or on an asset, the more risk you should expect. Small cap stocks offer the highest return by far, but they are also the most volatile. Treasury bills are the least volatile, but offer you a return that is just a little bit above inflation. Another way to think about it is, what if you put $100 in any given year and simply accumulate it for either 1 or 5 years so that we don't have such a strong cumulative effect, where maybe a good year in maybe the 1930s was really driving this big difference in cumulative returns over the entire 90 or so year record. What if we just look at any arbitrary year and just accumulate returns for 1 or 5 years? Well, we still see that generally small stocks will offer you the biggest returns, though often with the biggest volatilities, and oftentimes they will actually underperform lower risk assets as well. The S&P 500 will offer you still the next best returns and will also underperform risk-free or lower risk assets sometimes. Corporate bonds still also underperform the risk-free asset. And of course, generally, you wouldn't really expect to find a risky asset that would always beat the risk-free asset. Well, because then you could sort of view the risky asset as almost risk-free as well if there's no chance of loss. And the Treasury bill really doesn't offer you much of a cumulative return at all. So again, the basic idea is the riskier the asset, the higher the cumulative return, even on shorter horizons, 1 or 5 years, but the higher the volatility in these returns. And if we plot this sort of more systematically, let's just, instead of looking at cumulative return over time, let's actually plot the returns and volatility against each other. And we see that there is indeed, as we might expect, a linear relationship. Small stocks have the highest returns historically as well as the highest volatilities. Mid-cap stocks less in both. S&P 500 less in both, world portfolio a bit below that, corporate bonds far lower in both dimensions, and treasury bills far lower still. Now you might wonder, wait, the treasury bill is a risk-free asset, why doesn't it have volatility of 0? Well, the price of a treasury bill will still oscillate, as you now know from the fixed income lectures. You will just usually not lose money on your investment. In other words, your yield won't be negative, but it could actually, or I should say your holding period return won't be negative. But you can still actually have a varying holding period return. And if on top of that we plot the characteristics of a bunch of stocks, a couple interesting takeaways are observable. Generally, individual stocks seem to have similar volatility to, let's say, the small stock portfolio or the mid-cap stock portfolio, but oftentimes lower returns. So if you really want a good risk-return trade-off, these portfolios of small stocks, for example, or mid-cap stocks, seem to offer you far better combinations than any of the stocks, let's say, below the mid-cap portfolio, which have the same volatility as the mid-cap portfolio, just lower returns on the vertical axis. Same for all of these stocks here that have as high volatility as the small stock portfolio, or even higher volatility without necessarily having a higher historical average return. So this suggests that portfolios of stocks are somehow more efficient in making this trade-off between risk and return, and we'll actually mathematically see why. And the other thing, of course, is that, yes, it does seem that these investor preferences for higher risk premium accompanying higher risk do seem to hold. And of course they should hold, because even if the volatility of these assets is as given, it's investors who determine their price. So if investors have a certain risk premium in mind, they simply won't buy any of these asset classes unless the price gives them that desired risk premium, which then means that really it's investors that make the risk-return trade-off work. So what are some important numbers to keep in mind? This is useful for just sort of conceptualizing the magnitudes we'll be talking about when we talk about volatility and expected returns in this lecture, but also just a useful thing to keep in mind for your own investments, or for discussions when you actually talk about your own investment philosophy, what sort of the realistic benchmarks might be. So historically, the market return has been about 11%. The risk-free rate has been about 3.5%. Therefore, the risk premium, as the difference between these two, has been about a little bit over 8%. And the standard deviation of these returns has been about 20%. And if we look at the S&P 500 index as sort of our measure of the market, we see that, as expected, since it obviously has meaningful risk, it does have a positive expected return. There's more times when the return is positive than when it is negative. But there are, of course, substantial drawdowns. Another important thing to keep in mind is the role of inflation in this. Remember, when we were looking at those long horizon cumulative returns from 1925, we considered just what the role of inflation in driving any of these price gains would be. Because, of course, investors care about real, which is to say inflation-adjusted returns. It doesn't really matter if you earn 10% nominal. If the inflation rate was 11%, well then actually you lost 1%. So investors care about real returns. And that means that in times when inflation is high, well, the risk-free rate is going to be higher, and therefore the risk premium is going to be higher still. And one important thing to know is, in recent history, the inflation actually is much lower than it has been at some times in the past. Now, maybe this is due to the success of Fed policy. Remember, Fed has a mandate to keep inflation reasonably low. Maybe it's due to other factors, but for whatever reason it is, inflation actually recently has been much lower and much less volatile than it has been at various times in the past. And going to this idea of risk assets and their relation with the risk-free rate, we should expect and indeed do observe two things. First of all, risk assets, as broadly proxied by the S&P 500, do generally outperform the risk-free rate. In other words, the expected return to the risky asset is higher than the risk-free asset, but not always. Because the reason that it's higher is due to that risk premium example that we worked out. For you to be willing to invest in a risky asset, you should actually earn more than a certainty equivalent, more than you would get for sure at a risk-free rate of return. But for you to actually be worried about risk, there must be some meaningful chance of you underperforming the risk-free rate at times. And indeed, we see that during periods mostly of substantial market crashes, like the 2008 crisis, the dot-com crisis, the Great Depression, of course, you do actually observe market returns underperforming the risk-free rate. So now that we have sort of the playing field in terms of what historically we have observed in risk and return in risky assets, let's actually quantify the risk and return of a portfolio with two risky assets. Remember, previously we were able to draw this out as a payoff tree, and we could compute just sort of an empirical distribution of what the, let's say maybe 3 possible payoffs for a portfolio of a couple assets might be, like we did with the house and house insurance contract combined portfolio. But now let's actually generate a mathematical formula that'll tell us the expected return and volatility of any combination of two risky assets. So let's say that we've got two asset security. One has a certain rate of return peculiar to it, R1. That rate of return has an expected value, which we'll denote as mu1. Also, that rate of return, since it's a random variable, will have a standard deviation. We'll call that sigma1. And the reason that we discussed historical data at relatively extensive length here is because, as we were saying, that's actually a large input into what your estimates of forward-looking expected returns and volatilities of returns would be. Of course, naively, you could simply take the historical values, but usually, sort of in a more sophisticated way, you would probably just use them as inputs to a statistical model to generate forecasts. And of course, another way to get both a expected return and a volatility is to use fundamental analysis, either multiples or discounted cash flows, to get a sense of what the payoffs to a risky asset in the future might be as well. And let's say that we have another security with a similar set of characteristics, a random return and an expected value and standard deviation of that random return, analogous to security 1. So now, how do we actually mathematically express a portfolio with these two risky assets? Well, first of all, another thing we need to introduce is weights. How much of our portfolio on a, let's say, percentage basis or a proportional basis are we going to put in each of these two assets? Now, we might not start with these weights, but whatever we have in terms of positions, we can always calculate them. So let's actually do a concrete example. Let's say we have not weights, but share amounts. And we've got 100 shares of security 1, which is actually IBM, and 500 shares of security 2, which is actually Oracle. Now, how do we, from that, get to weights? Well, we need to figure out what our total value of the portfolio is and what percentage of that portfolio value each asset represents. Those will be our weights. So what is the value of our portfolio? Well, it's the sum of the value of our positions in IBM and Oracle. So if the price per share of IBM is 50 and we have 100 of those shares, well, that means that our value of the position in IBM is 5,000, right? Just 50 times 100. And if the price per share of Oracle is 20 and we have 500 of those shares, well, the value of the Oracle position is 10,000, 20 times 500. That means that our total portfolio is just the sum of those positions over 15,000, and therefore then the weight in IBM is the proportional value of the IBM position to the total position. In other words, 5,000 over 15,000, or 33%. Similarly, for Oracle, we've got 10,000 invested in it. Our portfolio is 15,000, so Oracle makes up 67% of our portfolio. And of course, we can sort of realize to ourselves that any amount that is not included in the first asset, if the portfolio is limited to just 2 assets, that amount has to be in the second asset. So really, if our weight in IBM was 33, our weight in Oracle could just be expressed as 1 minus 33. We get that same 67%. So now that we know something about our weights, can we actually get a mathematical expression for the expected return to our portfolio and the risk of the portfolio? Well, getting the mean return is fairly straightforward. Remember, returns are just linear combinations in weights. They're linear combinations in positions. So if you have 30% of your portfolio in a certain asset and it earns a certain return, and you have the rest in another asset, and that asset earns a different return, you essentially just weight those 2 returns by those proportions that the assets make up in your portfolio, and that is your portfolio return. So similarly, we can calculate the expected return to our portfolio as the weighted expected returns to each of the risky assets in it. So we know what the expected return to IBM is. We know what the expected return to Oracle is. Or we can at least create a model that'll give us a forecast for those. And we know the weights in our portfolio with certainty. So we can just distribute this expectations operator. The weights are constant, so we don't need to take expectations over them. We can just take the weights times the individual asset expectations. And so that's what we do. And so the expected return to our portfolio is just the weight of asset 1 times the expected return of asset 1 plus the weight of asset 2 times the expected return of asset 2. And we can generalize this further to a n asset portfolio. Let's say we've got weights 1 through n for each of the positions in the n risky assets. And assuming that we have some forecast for their expected returns, we can then generate the expected return to our portfolio of these n assets in very much the same way. So this is a formula that is simple and very robust. It can handle as many assets as you like, provided you know their weights and have a forecast for their expected returns. Now, risk is a bit trickier. Returns are just linear combinations. But risk, well, how do we measure risk? Remember, in modeling assets, we talked about how we would measure risk using either standard deviation or variance. And we defined what variance was as essentially the expected value of the squared distance between a portfolio return and its average. And so that means that if our portfolio return is still this linear combination of asset returns times their weights, and our expected then portfolio return is just the expectation of that, Well, then we can get an expression for variance that looks like this. This is essentially the variance of two random variables, provided that we know their weights and both their individual variances, and importantly, a covariance. Now, we talked about covariance, and we said it was going to be important, and here is where we will see why it's actually so important in portfolio theory. So the variance of a portfolio with two assets is just going to be the weight on asset 1 squared times the variance of the first asset plus the weight on asset 2 squared times the variance of the second asset plus a covariance term, which is 2 times the product of the weights times the covariance between these two assets. And as we saw in the modeling assets discussion, covariances can be negative. Assets can move negatively or inversely to each other, or it can be positive. They will move together, or it can indeed be zero. They will move independently of each other. And as we saw in that discussion, covariance has a useful and somewhat more interpretable cousin of correlation. So we can actually rewrite the same formula using correlation instead of covariance. Now remember, correlation between any two assets is the covariance between them normalized by the product of their standard deviations. Which means that what we can also do is we can actually solve for the covariance in terms of the correlation and the standard deviations, plug that formula that we have now derived for the covariance into our portfolio variance equation, and now we get this alternative version of portfolio variance, where now instead of the covariance we have substituted the standard deviation of asset 1, standard deviation of asset 2, and correlation between assets 1 and 2. And I mean, this is a simple formula, right? This just tells you what the variance of a portfolio with two risky assets is. But I will actually suggest that you remember this formula for a couple of reasons. First of all, it's simply a very useful practical tool for solving simple problems in portfolio risk. So you'll see these sorts of problems in CFA exams. You'll likely see these problems in your courses on portfolio theory. But more importantly, this actually gives you sort of a useful, broader insight into why correlation is actually so key in portfolio risk management. Think about it this way. This is just two assets, and you only have a correlation between those two assets. The formulas for variance of multi-asset portfolios we don't really talk about because they blow up. They will have still individual weights and variances, but they will actually have many, many more correlation terms. In fact, one correlation term for each possible pair. So for example, if you have 3 assets, you will actually have, well, the correlation of asset 1 with asset 2 with asset 3, and asset 3 with asset 1. So you'll have 3 correlations. And if you add another, that'll blow up even further. And one big insight that we can take away from this is simply that as you get multi-asset portfolios, really most of their variance will end up being driven by correlations. Another important insight is that as you try to measure the variance of a multi-asset portfolio, you will have actually potentially an explosion in parameters that you actually need to measure, because you will have many, many more covariances and therefore correlations than you will have variances. So this formula with just 2 variances and 1 correlation or covariance is simple, but you can generalize from it a lot of insights about portfolio management, which is why I would encourage you to actually memorize it. Even though its practical uses are limited, its intuition is actually profound.